The debate over whether interest rate cuts will crash the stock market is heating up as central banks around the world navigate economic turbulence. Historically, interest rate cuts by institutions like the Federal Reserve are intended to stimulate economic growth by making borrowing cheaper. Lower rates can boost consumer spending and business investment, theoretically supporting stock market growth. However, in the current economic climate, where inflation is still a concern and economic growth is slowing, the traditional relationship between interest rates and the stock market is becoming more complex.
Firstly, thank you for watching, and don't forget to smash that like, subscribe, and notification bell for more global finance uncovered, as we continue to work hard and around the clock to always deliver and improve on our content for you. We would greatly appreciate your additional support by you clicking the like button, notification bell, and subscribe button and joining our channel's growth.
One major concern is that a series of rate cuts might signal to investors that the economy is in worse shape than anticipated. This perception could lead to a loss of confidence in the stock market, prompting widespread selling. Investors might fear that the central bank is cutting rates not just to stimulate growth, but because it sees significant economic weakness on the horizon. This loss of confidence could trigger a sharp downturn in stock prices as market participants rush to protect their portfolios. Additionally, while lower interest rates are generally positive for stocks, they can also reduce the appeal of bonds. In a low interest rate environment, bonds yield less, making them less attractive to investors. As a result, some investors may move their money from bonds into stocks, inflating stock prices. However, if the economy is truly weakening, these inflated stock prices could be unsustainable, leading to a sharp correction once the reality of the economic situation becomes clear. Another factor to consider is the potential impact of rate cuts on corporate earnings. While lower rates can reduce borrowing costs for companies, they can also signal lower future consumer spending if the cuts are perceived as a reaction to economic weakness. If companies expect lower consumer demand, they may reduce their earnings forecasts, leading to declines in their stock prices. This could create a feedback loop where declining stock prices led to more negative economic sentiment, further pressuring the market. Moreover, the timing of rate cuts can also influence their impact on the stock market. If the cuts are seen as being too little too late, they may fail to provide the expected boost to the economy and the stock market. In such a scenario, investors might view the central bank's actions as ineffective, leading to a sell-off in stocks. Conversely, if rate cuts are implemented too aggressively, they could exacerbate inflationary pressures, ultimately harming the economy and the stock market.
Some analysts argue that the current market is more vulnerable to a crash following rate cuts because of the high valuations of stocks. The prolonged period of low interest rates has led to a significant run-up in stock prices, with some sectors appearing overvalued. In this context, even a modest economic downturn could lead to a sharp revaluation of stocks, especially if investors begin to question the sustainability of corporate profits in a weakening economy. Additionally, global economic conditions are adding to the uncertainty. Many countries are facing slowing growth, and central banks worldwide are grappling with similar challenges. If a global recession were to occur, even aggressive rate cuts might not be enough to prevent a significant stock market downturn. The interconnectedness of global markets means that problems in one region can quickly spread to others, compounding the challenges faced by central banks and investors. Furthermore, some experts warn that the psychological impact of rate cuts on investors could lead to unintended consequences. In a market where sentiment plays a crucial role, the mere announcement of rate cuts could spark panic among investors, especially if they interpret the cuts as a sign that central banks are running out of tools to support the economy. This fear could lead to a sharp sell-off, triggering a market crash even if the actual economic conditions do not warrant such a reaction. The potential for rate cuts to crash the stock market also depends on the broader economic context. If the cuts are made in response to a significant economic shock, such as a major financial crisis or geopolitical event, the impact on the stock market could be severe. In such cases, rate cuts might be seen as too little, too late, and investors could lose confidence in the ability of central banks to stabilize the economy, leading to a sharp downturn in stock prices. It is important to note that while the risk of a stock market crash following rate cuts is real, it is not a foregone conclusion. The outcome will depend on a variety of factors, including the strength of the underlying economy, the effectiveness of central bank communication, and the behavior of investors. Central banks will need to carefully navigate this complex environment to avoid triggering a market crash while still supporting economic growth. Continuing the exploration of how interest rate cuts might impact the stock market, it's essential to consider the historical context. Historically, interest rate cuts have often been followed by stock market rallies as lower borrowing costs stimulate economic activity. However, the current economic environment is unique, with high levels of debt, persistent inflation, and geopolitical tensions creating a more fragile backdrop. This raises the question of whether this time will be different and whether the traditional playbook of rate cuts leading to market gains will hold true. Another aspect to consider is the role of investor expectations. If investors believe that rate cuts are a sign of impending economic trouble, they may preemptively sell stocks to avoid potential losses. This behavior could create a self-fulfilling prophecy where the fear of a downturn leads to the very market decline that investors are trying to avoid. The psychology of the market, where perception often drives reality, could therefore play a significant role in whether rate cuts ultimately lead to a crash. The relationship between interest rates and different sectors of the stock market is also worth examining. For example, technology stocks, which have been among the most significant beneficiaries of low interest rates, could be particularly vulnerable. These companies often rely on cheap financing for growth, and any signs that economic conditions are deteriorating could lead to a sharp sell-off in the sector. On the other hand, defensive sectors like utilities and consumer staples might fare better, as investors seek safety in stocks that are less sensitive to economic cycles. The potential impact of interest rate cuts on consumer confidence should not be overlooked. If consumers interpret rate cuts as a sign that the economy is weakening, they might reduce their spending, which could hurt corporate revenues and, by extension, stock prices. Consumer sentiment is a critical driver of economic activity, and a significant drop in confidence could exacerbate the challenges facing the stock market. This could create a scenario where both the economy and the stock market are caught in a downward spiral. The bond market's reaction to interest rate cuts is another critical factor. If bond yields fall significantly in response to rate cuts, it could indicate that investors are expecting prolonged economic weakness. This might lead to a flight to safety, with investors moving their money from stocks to bonds despite the lower yields. Such a shift could put additional downward pressure on the stock market, particularly if large institutional investors begin reallocating their portfolios away from equities. Furthermore, the global context cannot be ignored. Central banks around the world are dealing with similar economic challenges, and their coordinated actions or lack thereof could have a significant impact on the stock market. For instance, if the Federal Reserve cuts rates while other major central banks do not, it could lead to capital flows out of the U.S. and into other markets, weakening the U.S. dollar and potentially leading to a stock market decline. Conversely, coordinated rate cuts could support global growth and help stabilize markets.
The role of corporate debt is also critical in this discussion. Many companies have taken on significant debt during the low interest rate period, and while rate cuts can make it easier to service this debt, they can also increase concerns about the sustainability of corporate balance sheets. If investors start to worry about the ability of companies to manage their debt in a slowing economy, they may sell off stocks, particularly in sectors with high debt levels, contributing to a broader market decline. Moreover, the effectiveness of rate cuts in stimulating economic growth is not guaranteed. In a situation where consumer and business confidence is low, rate cuts might not lead to the expected increase in spending and investment. This could result in a scenario where rate cuts fail to boost the economy, leading to disappointment in the markets and a subsequent sell-off in stocks. The risk of a liquidity trap, where monetary policy loses its effectiveness, is a real concern in today's economic environment. The potential for speculative bubbles to burst is another factor that could be triggered by rate cuts. If low rates have led to excessive risk-taking and inflated asset prices, a sudden change in economic conditions could cause these bubbles to burst. This is particularly relevant in markets like real estate and technology, where valuations have reached historically high levels. A sudden revaluation could lead to significant losses for investors, triggering a broader stock market crash. Lastly, it's crucial to recognize that while interest rate cuts carry risks, they are just one of many factors influencing the stock market. Geopolitical events, fiscal policy, and global economic conditions all play significant roles. The interplay of these factors will ultimately determine whether rate cuts led to a market crash or whether they helped to stabilize the economy and support continued growth. Investors and policymakers alike must remain vigilant, balancing the potential benefits of rate cuts against the risks they pose to the stock market and the broader economy. Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance uncovered.